Hi, welcome to the first video in the Introduction to Financial Markets playlist. I thought the best place to start this series would be to explain and go into the language used in investing in markets, in finance, just to give you a firmer understanding of some of the articles you may read and not understand, some of the things I say in my videos that you may not understand. I think the best place to start moving forwards is to just give you as a viewer the understanding of what these words that people say actually mean, right? So you might hear or you might read a headline that says yield curve inversion is a bearish signal for equities, and you might read that as someone who doesn't know what the terms mean and think, okay, this is just so far beyond me, I've got no interest in this, there's no way I could ever understand this. Well, it's really not that complicated, that phrase at least. And I really want this video to give you as much value as possible, and I want you to understand what these headlines you may not understand currently actually mean, and what the terms and the phrases actually refer to. So with that being said, let's get into the video. So the first place to start is bullish and bearish, right? And this is a term you'll hear all the time. And really simply, what it means is bullish is strong and going up, bearish is weak and going down, right? So here's a chart of the futures contract as of the 4th of October 2023. This is the futures contract on the price of the 30-year US Treasury bond. Now, it doesn't take a financial analyst to tell you this is going down, right? So this is in a bear market, or it is bearish. Okay, so that's the different types of, that's the different ways you can use the term. Or you can also say, I'm bearish on the price of T-bonds. So that's bearish. Now here is a chart of the US dollar against the Swiss franc over the last few weeks. And again, it doesn't take a genius to see it is going up, right? So that is a bull market or a bull run, okay? The dollar is bullish against the Swiss franc. These are all the different ways you can use the term. And what you could say is, I am bullish the dollar on the Swiss franc. Just to give you a bit more context in how the words are used. So that's all you need to know about bullish v bearish. That's it. Bullish is strong and going up. Bull market, bull run. Going down and weakness is bearish. That's it. So moving on to another term you'll hear all of the time is long and short. And this refers to positions that you or others are making in the markets. So if someone's long on a stock, what it means is they've bought it and they want it to go up. That's it. So long on a stock means you've bought it and you're in it wanting to go up. All right. And a short is you're trading against the price. You want the price to go down. All right. So you could say, using the example I just gave you, you could say I shorted futures on I shorted a future on the US Treasury bond, 30-year Treasury bond, if you were, again, any good at your job. And so a bear market would be a good thing for you if you're short on an asset, right? Whereas a bull market is good if you're long on an asset. So you could say, I'm long dollar Swissy, which is you have bought the dollar against the Swiss franc, or you're short US Treasuries, right? So these are the different ways you can use it, but that's simply what you need to understand. Long means you've bought and you want it to go up. Short means you're betting against it and you're wanting it to go down. So those are the sort of key things you'll hear about markets being said. But what about the types of markets? Right? You might read headlines saying equities are in a bear market, commodities are on a bull run. FX is incredibly volatile right now. Treasuries are falling. So here's what you need to know. Equities, The term equities refers to stocks. So equities means the stock market. And when people say the stock market, they're usually referring to stock indices, such as the Nasdaq 100, or the S&P 500, or the Dow Jones, or the FTSE 100. And all of these things these are called stock indexes. So they're just amalgamated, it's an amalgamated index based on the price of, in the case of the FTSE 100 blue chip companies in the UK. And the Nasdaq composite is an amalgamated price index based on 100 US technology stocks. So when people say equities are in a bull run, or equities are in a bear market, to use the latter, equities in a bear market means stocks are going down. And specifically, people are usually referring to these benchmark indices, such as the S&P 500, the Nasdaq 100, the Dow Jones Industrial Average, the Russell 2000, the FTSE 100. All of these are just specific stock indices made up of the price of however many companies are in the index. All right. So that's what equities means. It means the stock market. So another very, very important term you'll hear being thrown around loads is fixed income, or treasuries, or, to use another term, the bond market. And as the latter gives away, it's referring to the bond market, right? And generally speaking, people are talking about the US Treasury market, which is essentially government bonds, which you can buy. And I'm going to do, in future, I'll be getting into specifics of the markets themselves. So I'll do a whole video on the equity market, on the bond market, on commodities, on FX. And I'm going to save that for future videos. But what you need to understand, when people say treasuries or T-bonds or bonds, they're referring to US government bonds. And these are very, very different to stocks, in that fixed income, you buy it and the government pays you back. It's a fixed deal. And so on top of this, so that's an introduction to what treasuries means. Bonds, fixed income, T-bonds. Alongside this, you'll often read headlines talking about yield curve, or the yield curve, or yield curve inversion. And this very, very simply, so you have all of these different government bonds, right? Specifically T-bonds we're talking about now. You have, I think, 1 month, 2 month, 6 month, up to 1 year, 2 year, 3 year, 5 year, 10 year. You have all of these different bonds that are varying in their time frame. So you can buy a 30-year T-bond, so it holds for 30 years on a 10-year note, right? And all of these different bonds have different yields, okay? And all the yield curve is essentially the curve of how all of these different yields stacked up next to each other looks. So on a chart, you would usually expect the yield curve to be increasing. So the shorter termed bonds, so like the one year, 2 year, 5 year, usually would yield less than a 30 year. Because if you're paying the government, if you're loaning if you buy the bond, let's say, from the US government, and they're holding that for 30 years, you would charge them premium for having the money for longer, right? That's a general economic theory I'm just going to throw in for you. So the yield curve is essentially the price of the yields all the way down all of these US treasuries. So the 1 month will have a yield, the 1 year will have a yield, the 5 year has a yield, the 10 year has a yield, and it's how that yield curve looks across all of the different treasury bonds, right? And so you'll hear people talk about the yield curve inversion, which is essentially where the most recent government bonds, or the most short-term government bonds, so the front end of the yield curve, the bonds that expire quicker, sooner I should say, that's when their yields are higher than the long end of the curve, which is like the 10-year, the 30-year. So the longer out it goes, that's the long end or the back end of the yield curve. The front end is these really short-term bonds that you can buy and invest in. So when you're talking about yield curve, when they're talking about yield curve, that's what they're referring to. Government bonds having different time frames and different yields plotted against each other. All right. So yield curve inversion is when the front end of the yield curve, the most recent bonds, become more expensive than the longer dated ones. And I'll get into why that's important in a future video. That's all you need to know for now. So there's other markets out there as well. You can buy gold and oil and wheat and orange juice and coffee. These are all tangible commodities you can buy, and so the market is referred to as the commodities market, quite originally. That's about it. I'll do a deep dive in future videos. And then there's the FX market, which is short for Forex, which is short for foreign exchange. And quite simply, this is the currency exchange rate. It's the exchange rate market. So as I showed you earlier, the US dollar against the Swiss franc, the pound against the euro against the dollar, the New Zealand dollar against the Japanese yen, the Swiss franc against the euro. All of these currencies can be traded for other currencies. And the value at which those are traded at is worked out on the FX market, foreign exchange. It's the floating exchange rate between currencies. That's it. So when people say the dollar is strong, they're referring to the FX market, which is the exchange rate the dollar has between other currencies. So when the dollar is strong, bullish, it means the dollar is increasing against other currencies on the FX market. The dollar is very strong right now, by the way. So that's an introduction to sort of market jargon. But to understand a lot about markets, you have to have a firm grasp on economics as well. And a huge economic institution that carries an enormous amount of weight when it comes to investing and markets and trading is the Federal Reserve for US markets and globally. And this is the Central Bank of America, right? Here in the UK, we have the Bank of England. In the Eurozone, they have the ECB, the European Central Bank. In Japan, they have the Bank of Japan. Australia, New Zealand. All of these major economies that have their own currencies have a central bank, which basically determines the interest rates that the currency is held to. All right. So you might read a headline that says the Fed is hawkish in its monetary policy, and you think, what? What do those words mean? The Fed is referring to the Federal Reserve, which is the Central Bank of America. Then we have to talk about monetary policy. Okay. Well, first of all, actually, the first terms that you need to understand is dovish and hawkish. Okay. Hawkish is referring to a tougher stance towards something. And this can be used in geopolitics as well. And an example I can give you is, say you're in a wartime cabinet and you have a minister either side of you, and you're making a decision about whether to go to war. The hawk would be saying, yes, you need to go to war for these reasons. And the dove on the other shoulder would be saying, no, we should avoid war for these reasons. And this isn't to say one is better or the other. Obviously, I would say one is better in that specific instance. But when it comes to the Federal Reserve, hawks and central banks in general, hawks and hawkish policy members of the central bank are ones pushing for higher interest rates. So hawkish means higher interest rates, tighter financial conditions. Doves, being dovish, refers to lower interest rates and looser monetary policy, right? So hawkish is a stronger stance towards something. In the case of economics, it's usually referring to central bankers and their stance towards interest rates. And dovish means looser, more pacifying in a way, being a bit kinder, more gentle. And so in the case of economics, to go to the other side, it means lower interest rates, right? And which brings us to another key term, monetary policy. So there's monetary policy and fiscal policy. Monetary policy is what the central bank governs. Fiscal policy is what the government governs. So monetary policy is interest rates and quantitative easing or tightening. Fiscal policy is taxing and government spending. So whenever you hear people say fiscal policy and sounding all clever around around a table chat, whatever, all they're referring to is taxing and spending by the government. And the same is true of monetary policy. All people are referring to is interest rate levels and quantitative easing and tightening. Again, these specific terms I'll be getting into fully in future videos, but the general lexicon is what you need to grasp through this video, okay? So the Fed can be hawkish or dovish in its monetary policy stance. That is, the Federal Reserve, the Central Bank of America, can be higher or lower of its interest rates and quantitative easing or tightening policies, right? That's what the sentence means. So there is your brief introduction to some of the terms and words that are constantly used in the world of finance and markets and economics. This is just the first video of an entire video series I have coming up, which I'll be posting every single Wednesday as an introduction series to financial markets, to investing, to economics for complete beginners up to intermediates, I would say. So now you should have some fancy words and terms you can use to impress people at parties. If you do like this video, please consider subscribing. As I said, I will have lots of content planned along these lines, and I also every single weekend provide weekly market and economic updates on the week just been, as well as briefings for the week going forward. So if this sounds like something you could take value from, please consider subscribing. Thank you.